Hello class, this is Dr. Fenton. In this video, we're going to talk about Chapter 6. Now, as always, please read the chapter in detail yourself, and really you should read it several times. Okay, so let's get started. I'll lower my video. Here we go, Chapter 6. Now, the first part of this chapter talks about what the IRS uses to find people who are committing tax fraud, not reporting the income. And the thing about it, look at this very first line. The IRS and their agents were some of the earliest and most successful forensic accountants in the United States. I mean, for years, the IRS has had to worry about tax evasion. That's the illegal part of not paying your taxes. And they've come up with quite a few techniques to try to prove or disprove if someone is actually committing tax fraud. So let's go, let's see, a page or two. Yeah, right here. Okay, what gives the IRS the authority to use indirect methods to reconstruct a taxpayer's income? If a taxpayer is not reporting income and records are not so good, the IRS has several indirect methods they can use to reconstruct the income that looks like this is the income you should have had based on these items that we are pursuing, like your lifestyle, things like that. Well, Internal Revenue Code Section 446B gives the authority to the IRS to do this. And it says, you can see the quotes right under that, if no method of accounting has been regularly used by the taxpayer, or if the method of accounting does not clearly reflect income, the computation of taxable income shall be made under such method as, in the opinion of the Secretary, does not clearly reflect income. Now, the Secretary here is the Secretary of the Treasurer, and the IRS falls under that office. So we can look at things like lifestyle probes down here, and that could give someone clue as to maybe someone not reporting income. This can be the IRS looking at someone's lifestyle, or a forensic accountant looking at or noticing an employee's lifestyle, and they would think, well, why is the employee flashing all this expensive jewelry or have that real expensive car in the parking lot? That person doesn't make that much money from the company. Is something being embezzled from the company? Or in the IRS point of view, is all the income being reported on the tax return? And what you did mention that expensive cars, lavish residence, vacation home, private schools, vacations, expensive clothes and jewelry. This is what you start to notice. Does something just look out of place for the probable income that person's earning? Now, just because someone has these items doesn't mean there's anything nefarious. Doesn't mean there's tax evasion. Doesn't mean there's embezzlement going on. Maybe that person received a huge inheritance, a huge gift. This is just, these are like red flags. It says, I want to take a closer look at this situation. A red flag doesn't say, oh, something really happened that's illegal. No, just something to look at and explore further. And you can read a lot of this yourself. I'm going to try to make this video a little bit shorter. Indirect methods. So again, like I said before, inadequate book and records. Books don't clearly reflect income, then there's got to be some method we can use to try to establish how much income should this person have had to live this lifestyle, or whatever you're looking at. Now, as I said earlier, the IRS is one of the best forensic organizations that exist. I mean, they've been looking at things for so many years. Now, this market segment specialization program is really a neat program. I've looked at these guides in depth, for many years. These are great tools for anyone to use. Now, these audit technique guides, these are written by IRS agents with experience for other IRS agents. And they will take a certain industry here and say, if you're going to audit a taxpayer in this industry, here's a lot of background information on this industry. Here's how the book and records should be kept. Here are typical revenues, expenses, other information about the industry, and then here are a list of checklists you can go through when you're conducting an audit. And you look at all the ones they have here. They have more than this. Aerospace industry, transportation, attorneys, audit technique guide, consultants, entertainment, farmers, retail industry, and so forth. Veterinary guide, wine industry. So if you're a new accountant and you get a client who is involved in one of these areas and you don't know much about that area, get this guide. These guides are online. Go get the guide, read it, and that will bring you up to date very quickly on that area and really help you with dealing with that taxpayer. Next page. Again, you can look through this list and so forth. Public access records. All right. Now, what else does the IRS use? Well, here's a good and simple technique. It's called the cash T. And so, what an agent will do. Let me show you an example here. Here's a cash T, preliminary cash T. If the IRS agent is on an audit and they feel like, well, I need to explore this further, let's just check and see if it appears what the taxpayer is reporting on the tax return matches what they should be having revenue-wise and expense-wise. So you gather all the information you can, and most of the income goes here on the what we call the debit side, the left side. Your cash out, your expenses on the credit or the right side. What you do, you have a list of all kinds of possible revenues you might be having, all kinds of possible expenses. And then what you do, if the expenses here, the cash outflow, exceeds the cash inflow, like it says here, doesn't prove anything. It just shows it might be potential understatement. You use this as means to have justification to go forward and do more of an in-depth investigation into that taxpayer. So that's what the agents will use. You can use this, the agents use this if they're trying to estimate how much cash outflow does that taxpayer have. We're looking at personal expenses, groceries, clothing, and so forth, rent, mortgages, auto expenses, and a lot of things. So it's an organized way for an agent to try to figure out what's the actual cash flow for this person. Okay. When the agent is discussing, taxable income, deductible expenses, and so forth, the taxpayer, and trying to find out if there is unreported income, and you decide with the cash T that it looks like you've paid out a lot more than you took in, then the taxpayer might say, you know what? I already had that like at home. I didn't have that in the bank account. I don't trust the banks. I have like tens of thousands of dollars at home, just cash. Well, that could be true. It could be true. So what the agent needs to do right off the bat is see if there's a cash hoard, they call it, a cash hoard that the taxpayer has. Now, in the green here, a cash hoard consists of money that is not in a bank account, other related verification, that the taxpayer alleges should be in the beginning cash balance. So you say, well, I know it's not showing up in my cash T, but I had that at the beginning of the year. I was paying out cash for a lot of these expenses. So you need to get that verified at the beginning. Ask the taxpayer, do you have a cash hoard or not? The trouble is, the taxpayer might have a different definition of a tax hoard than the agent does. So the agent needs to make sure that the taxpayer knows the same definition the agent's using for a cash hoard. If you just say, do you have any cash in your mattress back in your house? The taxpayer could say no, because the cash might be in a like a little vault, a safety box that they bought, or a box or something, or hidden in the backyard. So you need to show or ask, is there any cash anywhere that you have saved, put away, or whatever? So you try to make this all-encompassing, right? Don't just be very specific. The taxpayer will have a way around your answer. Answer truthfully, but still not get at your what you're trying to understand here. So that cash hoard, very important. You don't want the taxpayer, like I said, to later on say, oh, I'm reporting all my income because even though I have all these expenses that are more than my income, I had that from previous savings in the past. You can read this for yourself, cash hoard in a gambling case. The final cash T, this is prepared afterwards. Very similar to the preliminary cash T. The agent will use this to, after all the investigation, put it all together to still see if it looks like there is unreported income. So you see at the bottom here a little bit more, and they get into accrual basis taxpayers with changes in accounts payable and receivable. So go through this yourself in a lot more detail. Let's get into another way to see if there is any unreported income. This is the source and application of funds method. And you see I have highlighted here, it shows the increases and decreases in taxpayers' account at the end of the year. Okay, what are we talking about? Well, when they say funds applied, it's saying, all right, what did you pay out? Where did the cash go? Well, some cash went into increase my cash on hand. It went to increase cash in the bank. Inventory, receivables, inventory, personal living expenses. I paid income tax. So this is all your outflow. Funds applied, your outflow. Or an outflow means you had some cash and then you increased your bank accounts or whatever. Okay, for sources of fund, where did your cash come from? And what you used to pay for some of these items up here. Well, I used cash on hand. It could be your cash hoard. I decreased my bank balance. That's where some funds came from to pay for these other items. My mortgage went up. Got some cash there. Let's see on the next page. I had some tax-exempt interest that wasn't on the tax return. Maybe left that out. Inheritance, I got some of that. So you have all your sources in your applications. You compare it. And so you paid out $329.2. Your sources only show $241. AGI as corrected. AGI thinking about the tax return adjusted gross income. You get in some other tax items. You're trying to get to a taxable income number. So tax income as corrected, based on what the agent did, sources and uses, allowing for itemized deductions, exemptions, taxable income should have been $51,600. You only reported, taxpayer, $23,700, and so it looks like we have some understated taxable income. The net worth method, this is to see how the person's net worth changed from the beginning of the year to the end of the year. And then to see if there was enough income to support that. Again, you're looking for unreported income. Okay, so this is an example here. First, we look at the living expenses. So food, real estate taxes, repairs, utilities, so forth. Personal living expenses, $17,100. Now let's go down a little bit further here. What you'll do is look at all the assets last year, this year. See what the changes were. Liabilities do the same thing. And so then you find out that here, the net worth 2021 was $18,900, 2020 $32,000, and so the decrease in net worth, because he's subtracting this number, was $13,100. Now the reason I have this highlighted is because there should not be a double underline under this number, the 13,100. It should be, really should not have any line to it whatsoever. Because once you find out, in this case, your decrease in net worth, you're going to add to this these non-deductible, according to the tax return, non-deductible expenses and losses. You're going to add these to it, and so when you do that, this shows you that your reconstructed adjusted gross income that, based on all these numbers, should have been on your tax return was $19,000. Then you reported AGI, also $19,000 from your actual tax return. So they're saying there was no understated income. on the tax return that was not on the tax return. So looks like this taxpayer is okay. Yes, now we have the bank deposit method. It is as easy as it sounds. The IRS agents look at the deposits going into the taxpayer's bank statements, the bank account, adding all those up for the year, compare that to the income reported on the tax return. Does it seem reasonable? Maybe the taxpayer had cash from, let's say, ill-gotten gains and thought, well, with all this cash around, I want to put it into my bank account so I can use it. Well, that can easily be located, and that's what the agents are trying to do here, is to see if any cash went into the bank account that was not reported on the tax return. And they have a little schedule to test that. And I'll let you read through that. And that, again, more on that method. Ratio analysis can be done. And now let's get into this area, contract and procurement fraud. We look at damage calculations in chapters 10 and 12 where there are some contract breaches. But, as you know, a breach of contract may occur when a party to the contract fails to perform or says he or she will not perform. The other party then may lose money. So that's a breach of contract. Now, the bigger area here is procurement fraud. This can happen in a number of schemes, methods, as they say here: bribes and kickbacks, bid rigging, defective pricing, phantom vendors, and a lot of others. So this can be a huge fraud area for very large companies. So it's something that really needs to be taken into a lot of consideration. You can look at these areas of concern and so forth. And again, you can look at that. It talks about bribery and so forth. The normal bribe kickback scheme generally involves something being transferred to someone, like either cash or vacation going to someone, and later influence of a business or official action. Okay, so what are we talking about? Some examples. Someone might receive cash, gifts, trips, entertainment, all kinds of other things. In turn, they might say, you know what, I will award you the contract. Even though it's supposed to be official bids put in, I'm going to make sure you win this bid. Or say, you know what, we'll sign the contract today. I'll make sure you get a higher price later on because you can say you went over budget or something. So you're trading one thing for the other. That's the bribe and the kickback. Happens all the time. What are some red flags? Look at these. Lack of standard invoices. Request for funds be routed to a foreign bank. Checks to cash. You can list the others. What are steps to help prevent this? Well, should be an approved vendor list, separate responsibilities, so the purchasing agent cannot approve the vendors. Should be an anonymous hotline for whistleblowers. And just look at the others right here. We talked about the Foreign Corrupt Practices Act, I think in the first chapter. It is a powerful tool the U.S. government has to stop these corrupt practices around the world. I want to show you on the next page, in recent years, look, in 2020, Goldman Sachs, big name brand company, had a $3.3 billion settlement. They had bribes to third parties and so forth. Government Malaysia and Dubai. Okay, so the fine was $3.3 billion. Airbus, over there in Europe, had to pay over $2 billion in 2020 because of usually bribes or kickbacks or something being paid to governments or some entities. All right, next area, piercing the corporate veil. As you know from your business law courses, is that when you have a corporation, if everything is handled correctly, the corporation's debts or lawsuits should not personally impact or go after the shareholders' personal assets. Now, the shareholders might lose their stock value in the company, but if the corporation loses a lawsuit, the damages should not be assessed personally against the shareholders. That's what you're hoping for. But in a lot of cases, people, especially smaller corporations, don't keep that corporation and the personal activities separate. They get combined. Therefore, when something happens at the corporate level, it might spill over and be the personal responsibility of the shareholders. That's called piercing the corporate veil. Okay. All kinds of attempts are tried. What would the court consider? To see if the veil is still there or if it's pierced and now the shareholders have to personally pay for some of the corporation's debts. Corporate debt was intentionally incurred. In other words, you took out and borrowed money when the company was insolvent. That could cause the shareholders to be personally responsible. Annual board of directors meetings were not held. Now, state law says you must have an annual shareholders meeting and the minutes must be recorded. A lot of small corporations might think, well, like I'm the only shareholder in the corporation, do I have to have a shareholders meeting every year and record what I discuss? The answer is yes. If state law requires it, and it does, you'd better do that. Or someone might try to pierce the corporate veil saying, you did not follow all the rules or the law that state law says you must have followed. And let's look at the next page. Other things you can worry about: records not timely maintained. Shareholders used corporate funds for personal reasons. Happens very often in smaller corporations. So you got to be careful. So there are 5 steps to help avoiding getting that veil lifted. Pay attention to formalities. Document major business actions. Do not commingle business and personal assets and some others. So you don't want this to happen, to you or your clients. So it looks like that's the end of the chapter. So again, a shorter video, and again, read it yourself. And as always, good luck with your studies.